right, cool.
Yeah, go ahead, you can do your thing.
All right. So good afternoon, everyone. It's good to be here and join everyone again. We're going to continue on the next phase of our workshop. This is the third of the fourth installment of this workshop series here. Okay, great. So, all right, what we're going to start with is the title for this particular presentation is Qualifying for a Mortgage. Also talking about mortgage types and searching for a home. So we're going to dig into some things from the past before we kind of get into that topic. So this is just a workshop series. We're all familiar with this. We already been through the other two. This is our third one. And we have one more coming up on 4/21. If anything changes with that, Pat will communicate it to you guys. So this is a recap. Why do I keep going back and revisiting some of the things we did? Because if you don't execute on the things we talked about, it's going to be difficult for you to reach your goal of purchasing a home. So I'm not going to go in granular detail on the slide here, but I do want to show you guys, what we talked about. Keep it in the forefront of your mind and ask yourself whether you've been executing. The one thing I ask you guys to do, I'm not checking homework here, but I'm just reminding you, think about your goals. How many times you revisit your goals. As I mentioned, I like to put my goals in front of me all the time, and that constantly remind me of what I need to do to execute it. Track your costs, print a bank statement, download the transaction activity, whatever you want to do, go through that. Understand what's your savings, your needs, your wants, and where can you cut back on, or where can you adjust to make sure that you reach your goal of purchasing your home. Another recap thing, the mindset. Nobody needs to volunteer on it, but I just want to, remind you with these few questions. What have you done to shift your mindset to become more focused on your goal or goals? Can you do more? Can you be more diligent? And the very last important thing on this slide, but it's the most important, is do you still have balance? Sometimes our goals can consume us to the point where it's like, this is all I'm focusing on. This is all I'm doing. But you got to ask yourself, are you still taking care of those around you, family and friends? Are you taking time for yourself to decompress and just enjoy something minor, whatever it may be? And, just keep that in mind. Don't let your goal completely consume you, but you do got to put in that work to make sure you get it done. So just keep that balance in mind. You'll understand what that balance is for you. Another thing is, that says mindset, but this is actually credit related. So are you monitoring your credit? What steps have you taken to improve your credit? And this was a key slide that we kind of talked about last week, the last session. We talked about going to get your free credit report and then going through it and see if anything in there doesn't make sense or is not applicable to you and disputing that information. Because once you get something removed off of your credit report, it helps your score go up. So my thing is, if it's not your debt or if it's not something that pertains to you, get it taken off. Or even question what it is. Because it's funny, I was looking at my credit report recently and I saw something on there. It was like an identifier. I didn't know what it was. I Googled what it was, and it was basically a Home Depot card that I had. So for a second, I was about to dispute it, but I was like, let me take it a step further and understand what this actually is. So the other things to keep in mind, use a credit monitoring application. Some are included in your bank statement. Your bank applications you may have, like Wells Fargo does it, TD Bank does it. They give you free credit monitoring. Or you can try some of those other places that are out there that I list here. All right, so wanted to recap on the things from the past. Just like I said, this is a building block sitting there. You can't accomplish this goal by sitting through one workshop. It's great that you do this in piecemeal so that people get the opportunity to ask questions and really understand the process from start to finish and really kind of ingrain yourself in that information and take the time to just become more thorough in your response of understanding it, how to question it, how you should react, and so on. So the first thing we're going to talk about is the basics. So it's just qualifying for a loan. So qualifications will vary from bank to bank. So I like to say the best way to kind of look and see where you can get the best terms for a loan is sometimes your broker might be the good one to start with, a mortgage broker. So they basically have access to a bunch of different banks that they work with. And from there, they're able to put your information in and see what results kick back. And then they can recommend, oh, based on the lenders that we work with, these are the rates we can get you. This is how much you'll need to down payment for, et cetera, et cetera. So they could like really lay out all of the information for you. But also, if you have a good relationship with a bank or your bank has great terms itself, there's nothing wrong with starting there as well. Credit unions are great in terms of their rates and the customer service. Even bigger banks have like some good exposure products that they can expose you to. So it varies, but overall the qualifications will vary, but they'll be around the same ballpark. Something to keep in mind, the documents that you'll need to qualify, they're going to pull your credit. Now, when it comes to your credit score, you can either let them know, come to them with the information and say, hey, this is my credit score. I pulled it. Can you just give me a quote based on that number? Or you can give them the right to actually pull that credit score. I always say, if you're going to shop around for a loan, get all your scores pulled around the same time, or you can just take the information to them and say, hey, this is what my credit score, let me know how things would look if I were to move forward. I see we got a raised hand in the group. Feel free to ask your question.
Yeah, brother Khalid, how you doing? Glad you on this series. I just wanted to ask, so if you do like a quick scrub of your credit, don't you get to call like better shots as far as like the rate that the bank might offer you if you know what I mean? If you do a quick scrub and it brings your score up, doesn't that help you call like a better shot? Say, oh well, that rate isn't gonna work for me. You might want to, check, look at my score again, and if it's raised, then that gives you a chance to get a better rate overall.
Yeah, no, that's some good comments. When you go through and correct things with your credit score, it's going to take like a month or two for it to reflect through. And then when that time comes, or you can just do it right away. It all depends on how you feel and your timing. But you can go to the bank, like whatever bank you're at, and just say, hey, what can I get for this? They'll tell you. And from there, you can either say, well, let me shop around more, or you can be direct with them. Is there anything you can do to improve these terms? Now, my thing is, when you're asking someone to improve some terms for you, it's best that you have a relationship with that bank. You may say to them, is there any way this rate can be better, or these terms can be better, considering that I've been banking with you guys for over 10 years. I have this number of accounts with you. I have these assets here. When you bring things like that to the table, it supports your argument on why you may deserve better terms. But they do have restrictions that they have to work within. But sometimes there is a little wiggle room for you.
Thank you for that.
Yeah, no, good question. Good question. And so back to the slide here. Another thing is your income. You got to have a job or some sort of income to where you're able to show the lender that you have the ability to pay a mortgage. So that's a really important thing. And the reason I got 6 months or more there, and this is going to vary based on your lender too, they want to at least see that you have a full-time employment for 6 months. So that's super important for them because that lets them know that, you have a somewhat of a steady job. But typically, they want to see that you've been working in a certain profession for 2 years. So there's some wiggle room with that stuff too. But that's where you got to talk to your lender about it, and they can go into more details about it. That third bullet there is the assets. You need money in your savings, your stock account, your brokerage account, whatever it may be, or you may have a retirement account. You want to be able to show that you have assets to make this purchase. So, of course, like for your savings, like you're saving up the money to purchase the property, so you may use that. With your stocks, it's an optional thing to where it's like sometimes they want to see that you have a certain number of assets to make them feel comfortable. So you may bring in your brokerage statements and like, hey, I own a stock portfolio of this much. With the retirement account, something that a lot of people aren't aware of, but you can actually borrow from your retirement account and use that to purchase your home. But you got to keep in mind that 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 option will vary depending on where your retirement account is kept. Some companies allow you to do that, or whatever brokerage company you have your retirement account, it may give you the option to take some of those funds from that retirement and either purchase the home, whether it's through tax-free distribution, or it could be just a loan from your retirement account. Those are details that you need to sit down and talk to with whoever the responsible party is. It's just an option that's available. And then the last thing is you need your lender. Your lender will help you determine your DTI. Your lender, we already talked about. You can go to banks or broker company, a mortgage broker company, or whatever it may be. But your debt to income ratio, DTI, is the most crucial thing in this formula when it comes to determining how much house you can afford. So I'm gonna go on this slide right here and kind of break DTI ratio down for you. It's basically a percentage, right? So it's a percentage that considers what activity you have going on just for 1 month. So they want to know your total gross income. So that's your gross amount, not the amount that you see on your paycheck, the net amount, because your net amount has your taxes taken away, has the benefits you paid for taken away, and any other allocation that you may have set up. But they look at the gross amount. So that plays into your favor a little bit more. So how can I say this? Say, for example, you make like, I'm just going to do easy numbers. You make $120,000 a year, and you basically divide that by 12. So that gives you $10,000 a month. And they use that as a fact to determine, along with these other components here, to determine how much home you can afford. So the next item there is your debt. They look at your credit card, your student loans, your car loans, your personal loans, whatever it may be, anything that you're paying down on a monthly basis, they look at that as well. And what they do is they only care about the minimum amount. So if you owe $20,000 in debt, but your minimum payment is $100, then well, let's just say let's say you owe like 20,000 in debt. Minimum payment is like $500 for all that debt. And what they're going to do is they're going to take that gross amount that we talked about earlier, the $10,000 you make a month, minus the $500, and that'll let them know what your remaining income is. And they use that remaining income, and then they divide it by the gross monthly income to get your percentage. Now, I'm a math guy, so I'm just throwing out a bunch of numbers there, but I like to provide people a real life example because it makes things easier for you to understand. So check this out. This is a tool from Zillow. I've used this before to kind of explain this for people so they can understand the whole idea of debt to income ratio. So let's just go ahead. Someone got a question?
Yeah, if possible, I could probably do it. I'm gonna try to get that link and just put it in the chat for people who want to play around with it on their
Oh yeah. Let me drop this on everybody right now, so everybody can have it.
That's such an important tool, man. I'm so happy you raised this up because I literally used this to get my crib 2 years ago.
Gotcha. Yep. This is a crucial piece to the whole thing. Yo, Pat, I'm sitting here. I forgot. Here we go. It's the chat.
Yeah. Appreciate you.
No problem. I be using Skype at work, so I was like, oh, what is it? All right, cool. So we got that. So let's say, for example, someone makes about like $55,000 a year, right? Let's say they got credit card payments up to like $300 or so. Car loans are typically about like $250 at minimum, around that amount. And let's say you got like $350 in student loans, right? So what's going to happen is this orange right here is the debt, right? The amount that you're paying, which is these three components there. Now, we're only using these three examples, but this option right here, see more, it gives you more categories. And, maybe if you got something that's not listed here, just throw it in the other section. But let's just say that, Let me see what else. Yeah, no, let's leave it here for simplicity. So this orange part right here is basically the debt you're paying back, these three categories, right? This will vary based upon your scenario. This teal color right here, this is basically an indication of the mortgage payment. All right, so in this example, we got $900 in debt from these three categories. And in this example, because we haven't adjusted this scroll bar yet, we have $750 in debt. Right? So let's not really pay attention to this remaining part. We're going to pay attention to these two categories and this percentage right here. So now it's 36% DTI, right? It says your DTI is good. Now, typically, lenders go up to that 50% mark. Some may go over a little bit more, like 55% or so. But what we're going to see is we're going to see the max that someone could afford with that income and those expenses every single month, considering 50% is the rule. So what we got here is, if these are your monthly debts and this is your mortgage payment, this calculation is indicating that you can afford $1,398 a month, right? This is nothing but someone plugging numbers. But my thing is, be real with yourself. Like, you know what type of debt you have. You know what type of expenses you come across every single month. Because this calculation doesn't factor in all those other things, like the groceries you have to pay for, the utilities you have to pay for, whatever it may be. For your own sanity check and to make you feel comfortable, I say leverage this little category right here. So you may say to yourself, I got another $1,200 in expenses or whatever, right? This could range over a bunch of different categories, right? So now it's on a type time where it's like, hey, you can only afford $192 a month on this, right? But let's say, for example, you had like an extra $300 in expenses. Okay. Then they're saying, boom, you can afford up to the 50% mark. That's $1,073 that you can afford in your mortgage. So even though this calculation might play to your favor, Pat, you probably want to mute somebody. So even though this calculation may play to your benefit, just like from the outside looking in, you have to be real with yourself, because the person that's doing a loan with you, they're just like, oh, this is your DTI, this is what you can afford. Oh, let's get you a loan for this amount or whatever it may be. No, you gotta say to yourself, like, what can I actually afford? What's my budget or my limit? Keep that in mind. So I want to pause there right quick to see if anybody has questions.
Yeah, I got a question.
Talk to me.
You got I'm looking at those numbers like you said, and it, it's, when we trying to shoot for something that we want, we might overlook some things. It's like, oh well, I forgot about this, or I didn't include that. So if you got a DTI that's like 18 to 25% before you do all of those like unexpected things you need to add, what do you think of that? What do you think of that number?
Well, I need real numbers to really make like an assessment and understand someone's scenario. That's why I think it's very important that we execute on some of the things I talked about before when it comes to budgeting, understanding how much savings you got, and the list goes on and on. So that's why we doing this in multiple parts, because it's a buildup. The stuff that you learned from the past and executing that, like understanding how much you bring in every single month, how much extra money you can bring, and your expenses, that will help you make this decision when the time comes. So executing some of the exercises I said before will really help you. But the lower you can have this percentage, the better. But just want to put that out there.
I'm a real numbers person too, so I'm going to say 25%, because the worst case scenario, I mean, if it's 25%, it's only going to drop from there. So what do you think of a DTI like 25%?
So like I said, the lower the better, but I'm just giving you a heads up on what lenders are going to be okay with. That 50% mark, I've seen or heard about like up to like around 55. Some probably even do more. But even though you have this calculation is solely used for your lender to determine how much you can, based on your finances, how much you can afford. But you have more granular insight on other expenses that you have to incur. So it's like a combination of minds coming together. Your lender says, oh, this is what we're going to lend. And you're like, oh, I like that number. But then you got to come on your perspective, the real world perspective, and say, I have all these other expenses to factor and account for. How much can I really afford? So even though this may say 13, 17, you may say to yourself, I can only afford $900 a month. So it's all about being real with yourself in this process. To answer your question, the lower the percentage, the better, but you still have to take the time to digest this and go through all the things that we kind of talked about.
So I have a question for you.
Talk to me.
So say when I go to this debt to income ratio calculator and I go through it, my percentage is high, where I have some like not outstanding debts, but I have debts that are impacting my ability to get a loan. I don't know if you're going to touch on it, but what should my focus then be, like to pay down certain loans, or what should a person do if their income ratio isn't favorable or at a good percentage?
Yeah, that's a good question. And these are all good questions because I feel like I can give you this catch-all like feedback, but it really comes down to me sitting down and really talking to somebody. But an example that you presented. So let's think about this. So it's more about like the scenario at hand. So say, for example, like me and my family are renting somewhere. We need more space soon. A baby is on the way, something like that. And you may say, and you also have debt you've been paying down. And you've been paying more than the minimum requirement, right? So say, for example, the amount that you were supposed to put down for the debt that you was $300, you've been throwing like $700, $800 on that debt every single month. Now, your family scenario is saying, we need a bigger home. A baby is on the way, right? So you may say to yourself, instead of me, even though I got that $300 I owe every month and I've been paying the extra $400, maybe I just need to pay that minimum $300 and start getting this home buyer process rolling. So in that instance, I would say do what you got to do for the family and the benefit of everyone, right? But if you're in a situation where you're the type of person where it's like, I want to completely get rid of my debt, I don't want to see it, and go the route of paying everything off and then pursuing the route of home ownership. So it's going to vary person by person, depends on their scenario, their finances. But I just wanted to put those two examples out there. We got a question?
Yeah, I don't think I formulated my question well. So I'm gonna put it like this. It's like your resume might be the tool that gets you in a room to get an interview, to get a job. I think it's like getting a loan or the mortgage is like getting a job. So I know that your credit score is one of the things that's going to get you in the room for them to have a conversation about a mortgage. So if your DTI is, let's say, you get that as low as possible percentage-wise, does that give you a better chance of shopping around for different lenders as far as a mortgage? I think that was the way I should ask my question.
That's cool. Your DTI is separate from the type of loan you can get. This helps determine how much mortgage you can afford. In terms of your rates, that's impacted by your credit score and the terms. So that's a separate idea. They come together to identify the loan product for you, which is like how much you can afford along with the interest you're being charged on that mortgage. They work together, but you got to separate them two and understand them separately before you can see the ideas together. So this debt to income ratio is solely focused on how much you can afford. And it gives the lender an estimate on how much they can receive. Along with, your credit score is considered too, but this is a crucial component.
Got you. So this is the difference between a 3-bedroom, 2-bathroom house and a 5-bedroom, 4-bathroom house.
No, the house type doesn't matter. It's just the value, because you can get a 5-bedroom house in North Philly, somewhere like in an area that's not up and coming yet, and it can be 200K. Whereas you can get a 5-bedroom house in the suburban area and it'd be like $1 million. That does not matter. That's a different topic there.
So when you said how much house you can afford, you didn't mean as far as like square footage, but that monthly payment.
Yep, there you go. And that ties back to our presentation right here, this slide, where I'm talking about how much you can afford every single month. So it's not about what the house makeup is, it's how much you can afford to pay every single month. Any other questions on the DTI? All right, we're gonna keep rolling. Don't be shy, I'm more than happy to go back to that if we need to. Now we're gonna talk about the loan types, the basics, like basic information you need to just consider. There are multiple loan types that exist, but today I'm only gonna cover 3 of the more common ones. So, because these are the ones that you're likely to see when you purchase a home. In terms of term, they are like 30 years or less, depending on what you can afford. Because you may say to yourself, I can pay this house off in 15 years. I'll take the higher payment. Or you may say to yourself, like, this 30-year period is right for me. Or if you say to yourself, I can pay this off in 22 years. But if you pay it off in 22 years, then you got to basically use one of the loan products that they have. So if I recall correctly, the terms are around like the 15-year mark to the 15 to 30-year mark. So you got to choose between those two. But if you like, no matter what, I'm going to make sure that I pay it off in 22 years, then you want that 30-year product. Now, in some places like out west where the cost of living is crazy, like in LA, they even do longer terms, like 35 years or something like that. But, since we're all in the Philadelphia area, this is something common. You'll see like that 30-year term. Another thing is the mortgage payment. What does it cover? It covers your interest, your insurance, your taxes, and your principal. Interest is basically the money that you're paying your lender for, for the home, for the loan for the home. The insurance, it basically covers any incidentals that may come up in terms of, I don't know, there's a bad storm. There was a huge leak in your house. Someone probably tripped and fell on like the cement outside for some reason or another. Those are some things that covered, but you got to talk to your insurance agent for real details, but I'm just giving you some examples. Another thing is the taxes. You got to pay taxes to the city for that mortgage. You pay your city taxes, and basically they allocate how they spend the taxes. Your principal is the loan amount. So if you get a house for $100,000, that principal is what you're paying down until it gets to zero. But when it gets to zero, what happens is, don't think that there's still not some things you got to cover. You still got to pay for your insurance and your taxes. Your insurance gives you the protection, and the taxes prevent the city from taking your property if you don't pay. And another important thing is get multiple quotes. You may find yourself working with a realtor, and they may say, "Oh, I work with this broker or this lender for all my stuff, like all my homes I sell." That's cool and all, but you still have the right and the ability to go out and seek, other options for you. So, any questions about that? All right, cool. We're gonna get on to the next one. We're gonna start talking about the loan types. Now, conventional is like basically like it's like some people may say standard or your traditional loan, or however people want to coin the term. It doesn't matter. I'm gonna break this down for y'all. So it's like 3 to 20% down payment you gotta put up. Less than 20%. If you put down less than 20% on a home, there's an insurance that you gotta pay. So that's basically letting the lender know. The lender wants you to have some skin in the game. Basically, you paying down a portion of the property. If you can't meet that 20% mark, and you may say, well, 3% is what I can do. They'll give you the loan, but the approach is basically they're going to have insurance on it because it gives them more security that you're going to pay this over time. A pro to this is the PMI, which is the premium mortgage insurance. It can be removed around that 20% mark, or whenever you get to that 20% mark, you can refinance, and that'll be another way to get to it. A con is a FICO score of 620. And the reason I say it's a con because some people, their credit is not in the best shape, but there are other loan types out there that you can do to still get a property. And that FICO score can vary. And another thing is the use of the property. It got to be a primary, a secondary home, or an investment property. You can use a conventional loan to get those. Next one right here is the Federal Housing Administration loan, FHA. That's what people are familiar with it. FICO score got to be 580. The pro is 3.5% down payment, right? That's pretty low. And the cool thing about FHA is, if I recall correctly, I mean, this is something you want to confirm with your lender, but that 3.5%, it's not just the home value. It also can cover some of the closing costs. So it's like really less money out of pocket, but double check with your lender on that. And then another thing is you can even have a lower credit score, but if you put up 10%, you can still get your home through FHA. Now, this is something now in terms of that credit score and what you can get, that's something you talk to your lender about, but I'm just giving you some general information that I've come across or I'm familiar with like through my passing. A downside to it is the mortgage insurance premium at closing and annually. This is similar to the conventional, but with FHA it's going to be there as well. Another thing is the occupancy of 1 year. You gotta live in that property for 1 year. That's just a part of the terms and agreement of FHA. If you end up moving out before that 1 year mark, and I don't know, someone were to find out through like one way or another, you could face penalties and fines and stuff for that. Another thing with FHA is it's your primary home. The cool thing about FHA and the conventional, I mean, you can get a single family up to like a 4-unit property with it. That's the limit for FHA. But with your conventional, you can go bigger. Or you can get 5 units, 6 units, whatever it may be. But put that out there for y'all. Go ahead, feel free.
The limit for FHA is 4 units?
Yep, 4 units you can do FHA. And it doesn't matter if one of those are commercial, you still can get that loan. So, in my opinion, if you are about to buy your first home and your scenario at hand doesn't matter or impact what type of home you get, consider getting a multi-unit property. It's a way for you to generate income, and it'll come at a cheaper down payment when you use FHA.
When you say multi-unit, what do you mean?
Multifamily, I'm talking about like a 2-unit property, 3-unit property, 4-unit property, because that's the max you can do with FHA, 4 units. All right, so another one, Department of Veterans Affairs, VA loans. I don't think it get no better than this. Like low interest rates, and even though like I'm not privy to like all the details around this because I'm not a veteran, and each bank will have details, or your mortgage broker have details on these type of loans, but the interest payments are low. So, but the interest rate, that is. A pro is the VA loans do not require a down payment or PMI, and closing costs is generally capped. So there's like a limit on the closing costs. So we're talking about, I know people who have used VA loans and they didn't pay anything on their down payment, which is pretty crazy though. But it's, it's a benefit for serving. So as much respect to those who serve. I mean, they deserve those benefits. Another thing is the con is more documentation required. That's really it. In my opinion, it's worth it. So those are the loan types. Oh, well, those are the government insured loan types. We're going to go to one more loan type, and I'm going to take a few questions from you guys. So it's adjustable rate mortgage. In my opinion, I say stay away from these, but everyone's scenario would dictate whether or not this is good for them. So interest fluctuate with the market after a few years. So how it typically goes is ARM mortgage, you may basically get a rate for like 5 years you locked in. It's going to be low. It's going to look good, but you got to ask yourself, are you going to pay that off in 5 years? Or are you going to refinance or something like that? Whatever you got to do to get out those terms, I recommend it because it can fluctuate with the market. A pro is the interest rate is low in the beginning, but it can basically go up. And if that interest rate go up, what happens is it makes your payment higher and more is unaffordable. That's the con to it. My recommended use is, the property is temporary or refinance to better the terms within that 5-year period or so. But I highly recommend you consult with someone before you determine whether or not you're going to get that arm. So, because it could, there's like a corny joke on it. It could cause you an arm and a leg or something like that. But yeah, just keep that in mind. It could work in someone's favor depending on the scenario. But if you're like your first time home buyer, I would kind of avoid that. Any question about those loan types? Remember, I only gave you 3. The ARM, the ARM, the government assured ones, and also the conventional. But if you got questions about those, let me know. All right, cool.
So I actually do got a question. So for my situation, like I'm just starting to build credit, right? I'm not even close. But I think the easier way would be, from what you made it sound like, for me to get a house. I've been looking online and I've been just observing what kind of house I can get into, and most of them are rehabilitated houses. Like I don't mind buying like a $60,000 house and then going in there and fixing it up for like 15,000 more. You know what I mean? So to speak, and doing the work myself. But if I was to do that and get this house, pretty much money talks for my situation. But you did mention that I might got this confused. FHA has something to do for like how long you've been staying on a lease with somebody, or is that what you were trying to
you gotta if you get an FHA loan, you gotta occupy that property for a year.
Oh, but that's only FHA. Everybody else does not look at like, okay, this guy's been, subletting or something like that. He hasn't really been in a place for 2 years under a lease.
Yeah, and it's best to talk with your lender about those terms, but FHA required that 1 year. Another thing is, say, for example, you got that home, fixed it up, and you rent out rooms to your friends. That's fine. You're still occupying. That's through FHA. And you can do the same thing for the other ones. There are people who, house hack, where you live in a property and you may rent out rooms or something like that. So
Yeah. Okay.
There's more layers to that too. And a quick question for you though. So just do your research when it comes to the house hacking stuff. But as for you, you said that you'll fix it up yourself. Are you handy?
Yeah, I work. I got tools and all. I've been doing construction. That's why I'm in college now, but trying to get away from labor. But
how long you been in construction?
About 10 years.
What specifically? Carpentry, electrical? What'd you say?
Carpentry and plumbing.
Okay, cool. You're a master plumber?
I am almost. I'm not gonna say I'm not certified, so I can't say I'm a master. I worked under the table most of my years.
Okay, cool. Hey man, if that's one of the routes for you to become a master plumber, it's benefits behind that. But yeah, man, working with your hands is clutch. Got much respect for tradesmen, especially for some of the things that I do. And but yeah, figure out the balance for yourself, how you can leverage both of those careers and make the best of it.
Absolutely, man. Cool. I appreciate that, boss. Thank you.
No problem. We got another question.
Now, I just wanted to let the brother know that whether he realized it or not, you was just on an interview, bruh. And yeah, this man do this. So you was just on the interview, bruh. And if you, as far as a master plumber, you have to be licensed and certified. So if you worked under a master plumber, you can also get with them and start getting yourself credentialed to get certified as a plumber as well. So I work in the building trades many years. My pops was a master carpenter. He put me in a carpenters union. I always kept my book current. So, I do computers, but I keep that in my back pocket in case I ever got to fall back on it. So
Appreciate it. Good
the
stuff.
things I got certified in is concrete and carpentry. So
Gotcha. And is it Gabe or Gabriel? Which one do you prefer?
Most everybody calls me Gabe. Sure.
Okay. Cool.
Yeah, but I still turn.
Yeah, man. If you ever want to talk offline, feel free to. I'm always looking for people I can work with on my team. Just I got
you do construction.
Real estate investor. So what? Basically CPA by trade, but real estate investor is just it's my side hustle right now.
Yeah, man. That's what I'm trying to get into right now. I'm trying to I'll be honest with you. I've been trying to save on unemployment because I took advantage of it. I get a pretty good much of a big check from last year working.
Okay, pause your comments right there. I don't want to. You say just in case you don't want to spill too much because it's being recorded.
No, you're good. You're good. You're good.
Okay, I don't want to get you in trouble.
No, you're good. But it's helping me out get to a certain amount where I can at least establish that down payment to start off rehabilitating houses and doing real estate from that jump. And I'm almost to the point where I need to go back into either the working field of trade or some type of money income that I know it's gonna at least perform my future goals for. Obviously, I want to maintain construction. I got tools. For days. They've been sitting, really.
All right, cool.
I'll touch base with you, man.
All right, perfect. All right, thanks for that.
My fault, Khalid, but I see you, Ed.
We got a question?
Oh no, I was just appreciating his Ed's renovation and him putting his crib together.
Oh, that's pretty cool.
Pat, what's up, bro? What's going on, man? My bad. I'm coming here locked in. Leaf, what's going on? How y'all feeling, man?
Doing good. We're doing good. All right, we're about to hop on to the next section here. Finding a home. How do you find it? Basically, multiple listing service. That's something that your realtor will have access to. Is basically a list of properties in a particular area that are being sold. They got a lot of good data in there to determine, basically give you what you need to help make your decision. That's the most accurate, in my opinion, source. And then there's places like Zillow, Redfin, Realtor, Trulia, or whatever it may be. They actually pull information from the MLS and other sources as well. But MLS, you typically have to be a licensed realtor to get access to that. But there are tools and stuff that are out there for us to get access to by just going onto the website. Another one is an agreement with an owner. Say, for example, you live in a particular area and you know someone interested in selling their home. What you can do is you can just have a conversation with them and let them know, hey, I'm interested in buying for this particular amount, or whatever it may be. And you guys don't even need a realtor in that scenario. The most important thing is getting a title company so that they can make sure that that title for that property is clear and there's no issues. Like, you don't want to buy a property and then find out there's a $30,000 lien or something like that on it, because if it is, then you become responsible for it. So one thing I recommend is, no matter how you buy your home, make sure you get your title insurance done. You do it all through a title company as well. That's super important. But what we're going to do is we're going to visit a website right quick. Let me see how much time. All right, yeah, we got 2 slides. I'm going to try to make this pretty quick for y'all, this demonstration. This is realtor.com. So I like this website because it gives me a little extra details that I prefer to be beneficial for me. Where do we start? Someone shoot out a zip code that they would be interested in Philly.
Quick question.
Sure.
Hello. I have a PopStream account. So
PropStream is great too.
Oh, okay. Just wanted to make sure. And 19121.
Okay. And the reason I didn't really touch on PropStream because typically like investors or even realtors, they have access to that. But PropStream is a great one. You guys can get access to PropStream just by paying for a membership. So let's check out, so we're in a 19121. That's a zip code. There's other parameters that you can use here to say what type of home you want, whether it's condo, multifamily, whatever it may be, whatever fits your, your preference. We got the beds, bed size, baths, listing, status. This gives you more details on whether it's a new construction, existing home, foreclosure. This is basically the bank is trying to get back a property because someone stopped paying on it. 55 community, 55 plus community, individuals who are around the age mark and who maybe want to just live with individuals in their age group. So they may select that as an option. And these are some other details. Pending, contingent. When you see that, that means that the property is under contract, but they haven't sold it yet. When it says closed, that means the property has been closed or sold. It means that the property is no longer available. I like to see this as there's still hope. So if you see something like this, there still is a chance that you still can get that property. If that buyer if the buyer or the seller do not fulfill their obligations, then what'll happen is that property then becomes available again. And there's just some more categories, and you got even more filters you can check out. So you may also say there's something you want to see. You want to see a pool, you want to see a waterfront, maybe a specific school district or whatever. So I like realtor.com a lot, but there are other sites out there that you can check out. So if anybody's out there, how about this? Because the price range can be high in the zip code. Let's just say, you were looking for 3 beds and you wanted 2 baths in your home. And boom, you see how it already started populating the results? And basically, you kind of stroll through here and see what you specifically want, depending on your price range. Let's just check this home out right here, 260. You pop in, and it'll have all the pictures of the property, right? The kitchen looked great. The exposed brick looked great. Carpentry looks pretty good. Looks really good, actually. And then you just scroll down and you start to see even more details about the home. This right here indicates how many days it's been online. The cool thing about that is you can use that in a sense, you can use that to your advantage. Like you may see that and you might say, oh, this house has been on a property for like 50 days. Why? Or in this instance, it's been on 29 days, considering how crazy this market is right now. What's going on with it? You may want to check it out. Year built, that's another important thing. 1915, it's an older home, but as you can see, it's been rehabbed. So, you're hoping that they did their due diligence, making sure everything is good from a structural standpoint. You go in here, sometimes they have open house information, property details. This is basically describing the listing itself. It'll just talk about the same stuff you'll see in the pictures and more. And they might say, oh, great neighborhood, or whatever it may be. Home value. These websites have details about the home value. I don't really like to rely on this information that much. I'd rather understand what the comps are in the area. The comps is the comparable homes that have been sold within a close proximity of the home, probably like 0.25. You don't really want to go beyond a mile away from that home. This is other categories that are beneficial, right? That you may want to see. Right now, schools is important for me, like to consider because I have my daughter. But another thing is monthly payments. You want to come in here and kind of use this tool a little bit and see how much would it be you would have to pay. So if this is the price of the home here, this is your down payment. You got your 30-year fixed mortgage here. Let's just do 30 with the FHA. And let's say, for example, you did that 3.5% that we talked about. Let me get that correct there. 3.5. And this is the interest rate. So they're saying, oh, you have $9,100 for your down payment. And this could be your mortgage every single month. So this helps. You want to definitely talk to your broker and have them run all the numbers through and make sure everything is good. But yeah, these websites can be a heck of a tool. The cool thing about it is they also allow you to get a little look of the neighborhood, but I like to use Google Maps to kind of look around and see what's in the neighborhood or what's around it. But don't be afraid to do not shy away from these websites. They're great tools, they're very beneficial for you, like on a home search. Any questions about that? All right, cool. I'll get back to the slides. This is crucial right here. There are grant programs out here where you can basically use them to help buy a home. I'm only going to talk about one that I'm aware of, and there are others. Talk to your realtor; they may have access to this information. But I literally know someone who used this program and didn't come out of pocket. So this is a link right here that I have to get you to the Philadelphia site, and it talks about the program. So basically, you got to go through a counseling program to become eligible to get this grant. And they'll basically talk through some of the things that I've talked through, understanding the whole process. But more importantly, they get more granular. You get that one-on-one attention. They be like, how much money you bring in? How much expenses do you have? Let's figure out how much of a home you can purchase or pay for it. And then on top of that, it's just like a ton of resources that they bring and come through. Like, I'm one person. Like, even though I have this knowledge, I'm not a realtor. I'm not an insurance agent. I'm not a broker, a mortgage broker. They put those type of people in front of you so you can learn even more or even build or have them as a contact for you. The grant that you can get is either $10,000 or the lesser of 6% of the purchase price. It is income-based. They have the thresholds on the site and they let you know, like based on this income, you can get this much of the grant. But this is crucial right here. I highly recommend it. If anyone is looking to buy their first home, don't pass this up. Look in the details on it. And that with this grant, you can keep more money in your pocket. Any questions about that before we go on? All right, cool. So like we said before, guys, is like, I'm going to give you all the information that you need in terms of buying your first home. Well, not all of it, but a lot of the information that you'll need. But I also like to touch on how I look at things from an investor's perspective, from the topics that we just discussed. And these are the three categories I'm going to touch on really quick. Qualifying for a loan. So it's not as paperwork heavy with the lenders that I work with. So it's more of like, hey, let me see your financials and your tax returns. Let me make sure you got the money in a bank account to close on this property. They look at those two things, they see what they need, and they're like, cool, when you're ready, we can get this done in 2 weeks or 1 week, depending. So that's the type of stuff that that varies. Hold on 1 second, guys. Let me see something. All right, sorry about that, guys. I had to answer that, but that was an important one. So as an investor, those are some things. It's pretty straightforward. It's a little easier to go through that process. Because I got because you have to have the assets to show that you can purchase on. Loan types, you can buy a property in cash if you got it. You use your hard money lender. That's something we talked about in the previous presentation. But it's basically a loan term, but the interest rate is higher. The whole objective is to use that loan for the purchase of the property and the construction, and then you refinance out after that. Another thing is buyer financing. If someone owns their home outright, then you essentially can have an agreement going with them. Get a lawyer to draft something up, and have it all signed off, make sure it's submitted to the title company. And then what you can do is basically, you can say, okay, I'll take possession of this home, but I still have to pay you a payment every single month to pay down this amount. And another important thing is like how to buy. With me, I work with wholesalers, word of mouth. I tell people that, I'm investing. You can go through the auctions. Philadelphia got its own auction. There are auction sites as well that you can visit, like auction.com. And another thing is create your own leads. Even though wholesalers typically go out and find properties and present them to buyers, you can do the same exact thing, but you can do all the legwork yourself and essentially create that lead for yourself and purchase that property from the owner. So yeah, that's how it is from an investor perspective. Like one example is like right now I have a property under contract. I literally just talked to the owner. Someone told the owner that I invest in real estate. The owner, and then they came back to me and say, "Hey, this person is interested in selling. This is the address. Would you be interested in buying?" I looked at it. Meets, like it meets my my ideal, like it meets characteristics of an ideal property for me. And I submitted an offer, and there's only an agreement between me and him. Right now, we're doing everything we need to do to make sure the transition of the property is done appropriately. So, you know, options and opportunities are limitless out there. It all depends on, how you go at it and attack it. But remember, this slide is solely from the perspective of an investor. You got to do your own research to figure out more details about some of these things, but I am willing to answer any questions that anyone may have about this. Any questions on that slide? Cool. Now, so that's it in summary right there. Next time we're going to talk about inspections, closing, and any other final questions that you guys may have. But before we close out, I'm here. Anybody got any questions? Anything that we talked about today from the past, or something specific to your scenario when it comes to like trying to purchase a home? I'm here to just close in and answer any questions that you guys may have.
Well, I mean, brother, could you possibly go back to that last slide? I've been taking pictures of the slides as we go along.
Gotcha. And this recording is available too, so.
Thank you, bro. Got it.
All right, Pat, nobody. You got it, right? You got the picture?
Yes, sir. Thank you very much. Thank you.
Pat, I think that's probably it on my end. Anything you want to close out or any comments?